The benefits of rebalancing your portfolio. Let's dive into this. This is an article that Michael Edison cited when he said the rebalancing isn't all it's cracked up to be. So it's interesting. We're going to read this by a couple guys, CFA. One guy's a CFA from Morningstar. The dateline is January 21st, 2020. Keep your portfolio's risks in check with this one simple trick. All right. Let's see. Who are they? Do we know who they are? Who these guys right here? They don't tell us who they are. All right. Anyway, let's dive into this. I don't know Adam Milson or Jason Kephart. Over the past decade, investors have become accustomed to U.S. stocks hitting new all-time highs. While the expanded bull market has been a boon to portfolio balances, investors that have let the market rise drive their equity allocations may now be holding riskier portfolios than they initially signed up for. For example, a hands-off investor that built a traditional 60-40 portfolio years ago would have a portfolio that's closer to 80% equities now. It's possible our hypothetical investor's risk tolerance skyrocket along with the stock market, but it's more likely that the current portfolio no longer resembles an appropriate blend of risky and safe assets. What's safe? 40% bonds? Is that safe? You think about it too, like, yeah, let's actually tell you, let's check this out. Hold on a sec. So here's VTI, the Vanguard Total Stock Index. We put 10,000 in on 10 years ago in 2010. It's worth 37,743 now. All right. So let's check that out. Let's say we have a 30% decline. It drops by 30%. All right. So now we got minus, we got 37,343 minus 30%. Now we're down to 26,140. All right. So I'm using a 30% decline. So that's a pretty significant bear market. All right. Hold on just a second. So here's a Vanguard Balance Fund, 60-40 between stocks and bonds. Right now it's at 26,786. So let's just say it drops, let's say 15%. So it drops, let's say 20% because it's got 60% stocks, 40% bonds. We'll say it drops 20%. So we started with $10,000 in 10 years ago. Now it's worth 26,786. We're going to subtract 20% off that, which is 33% less than the S&P 5 or the VTI. So we got 26,786 minus 20%. Now we're down to 21,428. So the question that comes to mind, and that's just looking at a straight stock fund versus a 60-40 perspective. We're still $5,000, almost exactly $5,000 ahead of where we were with the VTI than the balance fund. So let me give you another example. So we're going to start with $10,000. Hold on a second. Go with that. Yep. Okay. $10,000. Present value, 21,428 is our future value. We didn't make any payments there for 10 years. And what is our rate of return? 7.9. All right. So 7.9 is our rate of return after we lost 20% in the balance fund. All right. So now we start. Now we got 26,140 future value. It's 10.08. So here's the deal, man. That's an extra 210 basis points. So let me tell you what I'm talking about. All right, let me show you what I'm talking about. So we took the balanced fund and it's balancing itself, it's rebalancing to keep a 60-40 portfolio each and every year. That $10,000 that you started with is now went up to $26,000 at the end of, we'll just say last year, and then it got hit by 20%. Now it's only worth $21,000. That's a 7.9% rate of return. Or we just put it all in the VTI. That VTI went from 10,000 to 37,000. It got hit by 30%, and now it's worth 26,140. That's still a 10% rate of return, even after a 30% decline. I think my lump of coal tells me 10% is significantly higher than 7.9, even getting hit drastically more by a negative event here. And so the balanced fund would have underperformed by 210 basis points or 2.1% a year on average. That's crazy. Let's. I'm just curious too. Let's. How much can we go back to? All right. So let's write these numbers down. VBINX. I'm just using ETF for the S&P 500 or the total stock because it's easier. All right, so let's check this out. The balanced fund. Let's see what it did in 2008, shall we? So let's go to 2008 and see what the balanced fund did. I have no idea. It was down 22. Yeah, 20, I mean almost like Wellington actually, 22.21%, minus 22.21. And let's see what VTI did in 2008. VTI. All right, let's take a look. It's down with 38%. 2008. I gotta go to performance. It doesn't give us a year over year, or does it? Yeah, down 36.97. So there you go. So I was right on. I said the balanced fund would drop about 20. Yes, the VTI would drop 30, and in 2008 the balanced fund was down 22, and VTI was down 36. So that's pretty spot on, man, without question. Interesting, isn't it? So let's keep going back. So that's of interest to me. So the balanced fund did not give you the reprieve. I wonder if we can go back. Yeah, let's just keep. Oh, the market's getting crushed today. Wow. All right. Well, it's time to buy. I got no cash to buy, baby, other than my monthly or annual investments or bi-weekly investments. All right. Let's keep reading the Morningstar article. Rebalancing, right here. Rebalancing or selling a portfolio's best performers to buy the worst performers is one of the best ways to protect against market movements. The advantages of rebalancing are especially in parent and tax-favored accounts. May also be prudent in taxable accounts, but that does trigger tax event potentially. All right. There are multiple rebalancing strategies, Before we dive into those, we'll first have to examine what the investor experience would have been like over the past 26 years without rebalancing. To illustrate a buy and hold investor's experience, we built a 60-40 portfolio using the following indices: S&P 500, FTSE All World, and the Bloomberg U.S. Aggregate Bond Index. All right. We ran the portfolio's return over the past 26 years from 1994 through the end of 2019 and tracked its equity allocation and drawdowns over the same period. Okay. Let's see. The portfolio's equity allocation grew to 76% from 1994 to August of 2000, right about there. And then before the financial crisis hit, and then with 73% in equities at the end of, again, peaked before the start of the financial crisis in 2007 with 73% equity. So it went from 60 to 40 to up to basically 75-25. Unfortunately, the elevated allocations heading into the two bear markets of the past 20 years meant more pain during those drawdowns and a longer wait to recover those losses, all right? So we have a buy and hold portfolio yearly rebalance. The max drawdown was 28% in the buy and hold, and the max drawdown in the yearly rebalance was 20%, okay? It took 29 months to recover in the buy and hold and only 15 in the rebalance one. See what I'm talking about? Are you still the 2007-8 financial crisis? The buy and hold was down 36%. The yearly rebalance was down 31%, or 32%. It's like, come on, man. What's the point? Let's see. I just, oh my goodness. I'm only down 32%. I could have been down 36.6. No one says that. Says no one ever. No one says that. It's freaking nuts. Let's see. Okay. Over a 25-month period, the rebalanced portfolio experienced a 20.7% loss, outpacing the buy and hold by 760 basis points. Okay, so it didn't go down as much, so it didn't take as long to come back. Okay. All right. Let's see. The experience of buy and hold can be tumultuous, but rebalancing can help smooth out the ride. No, it literally does not smooth out the ride. You were down 36.6% in buy and hold and 31.9% in the rebalance. That doesn't smooth out the ride. Let's see. So what we're comparing. All right, let's see what we got. Exhibit 3 illustrates that buy and hold earn slightly higher returns than all the rebalancing. However, it also has significantly higher volatility because its equity weighting increased such levels during high. Okay, well, that's over from 1994 until at the end of 2000. What did it do? 1994 to the end of 2000 and what? Through end of 2019, I think. No, unfortunately, what are we doing here? We rebalancing. Okay. Well, what are we doing? To the end of 2019? Is that what we're doing? Yeah, we ran the portfolio's returns of the past 26 from 1994 through the end of 2019. Okay. How often should you rebalance? Blah, blah, blah. So the buy and hold did better a little bit, but it had much significantly higher return. So here's the buy and hold is 8.01. Daily rebalancing, which would be silly to do. No one's going to do that. Monthly rebalancing, that'd be silly to do. Don't do that. Quarterly, silly. Yearly rebalance. So we got 8.01 in the buy and hold. You had 7.98 in the rebalancing every year. So 3 basis points different, not much. Over 10 years, you had 9.79 in the buy and hold and 8.61. So pretty significant in the last 10 years, which would make sense. So basically, the buy and hold outperformed every time. 3 years, 5 years, 10 years, 15, and since inception, I guess they're going back to 1994. In the long term, it wasn't that significant. But the reason for that is because the stock market got crunched in 2000 to 2002, and then again in 2008. Basically, those are once in a generational declines for sure. But we had 2 in one consecutive decade. Crazy. Sharp ratios, no one cares about sharp. I mean, I'd say, look, I get the academics need something to care about. No one sits there and says, oh my goodness, my sharp ratio is only 0.58. My sharp ratio is 0.65. No one said, no one ever. That's it. That's it. That's the reasons to rebalance. I mean, that's it. Okay. We control our portfolio's risk exposure through prudent rebalancing, and history suggests it'll lead to better results, but it didn't lead to better results. Yeah, that's straight up dumb, man. I'm sorry. I shouldn't have wasted your time with that. I thought there'd be more to that. That's it. Just said, look, you didn't get as much return, a little bit, but you had a little bit less volatility. Okay, you're still down 32%, bro. Come on, man, says Sniffy Joe. All right, I frankly, and if you're contributing on a regular basis, you're not pulling the money out. I just don't believe in rebalancing. I just don't. I mean, I got no qualm if you do. I don't care. I don't. I just go. I believe in equities and cash. That's it. But be that as it may, just thought I'd share that with you. All right, I'd love to hear your comments down below. See ya.